Good morning, everyone. I'm Jeff Mechanic. I am a senior project advisor here at the Financial Accounting Standards Board, and I'd like to welcome all of you to our semi-annual meeting of our Not-for-Profit Advisory Committee, or NAC. I want to particularly welcome our board members. We had Christine and Fred for the closed session that concluded a little while ago, and I'd like to now welcome Rich Jones, Hillary Salo, Sue Cosper, and Joyce Joseph. I also like to welcome our audience who are listening in, as well as, again, welcome everyone else around the table, NAC members and others, including some who are online joining us virtually. Let me turn first to Jeff Gabello, who will give us a brief reminder of meeting protocols, and then I'll talk about meeting objectives.
Okay, thanks, Jeff. So yeah, it's for the people on Zoom, for the participants on Zoom, please use the raise hand function or wave, or just let us know that you're ready. We will be following everyone in the queue. And for those in the room, just please turn up your name card when you'd like to speak. Press the microphone button, and then when you're finished, please shut it off and turn your name card down. And if you really want to say something to address something that someone has just spoken about, it's just please use the touchdown signal or wave at us, and we'll let you speak next in the queue.
Okay, thanks, Jeff. So let me just set the stage a little bit for this meeting. The meeting structure here is very much driven by where the board is in its standard setting activities. The board we've completed or will soon complete much of what's on the technical agenda, projects that were by and large added to or modified as a result of the 2021 agenda consultation. Some accounting standards updates, ASUs, have already been issued, and we'll talk about those, while redeliberations of others have been completed, and final ASUs will be issued in the next few months. I'll also mention a few of those that are relevant to the nonprofit sector. Now, beyond drafting those final ASUs, much of our work has been focused on the research agenda, including a public agenda consultation that will help shape the FASB's agenda for the next few years. We'll begin the meeting with a public report out of the discussion we had in closed session on emerging financial reporting issues identified by NAC members. And as with other advisory groups, this standing agenda item involves one of the most important roles of the NAC, to be our eyes and ears for what's going on out there that could warrant the board's and staff's attention. Then in topic 2, the staff will report on what we've heard in the public agenda consultation and gain NAC members' initial feedback on what we've heard and its applicability to the not-for-profit sector. This will involve some closed breakout groups before lunch, and then a public report out from the groups following lunch, led by NAC members. We'll then move on to topic 3, where we'll focus on our Intangibles research project, which was first discussed with the NAC at its March meeting. Here, the staff will discuss what we've heard from respondents to the invitation to comment and ask NAC members for their feedback from a not-for-profit perspective on key themes heard from respondents. With topic 4, we'll be asking NAC members for their feedback, especially about applicability and pervasiveness in the nonprofit sector on 2 items. First is a project recently discussed by the Emerging Issues Task Force, EITF, and soon to be discussed by the board at the EITF's recommendation. That's on the application of topic 715, retirement benefit accounting, to market return cash balance plans. The other item is a research project of the Private Company Council, PCC, on subjective acceleration clauses and material adverse change clauses. Then in topic 5, we'll move on to the technical agenda projects recently or soon to be completed via issuance of a final ASU, and Nellie Debler will update us on these, focusing on key developments since the projects were last discussed with the NAC. And then finally, in the meeting wrap-up, I'll do something that I always find bittersweet, which is to thank and say goodbye to members whose terms conclude at the end of this year. And this year, there'll be 7 members who fit that category. So again, that's what we're going to try to accomplish in the next few hours. And again, thanks for being with us here. So moving on to topic 1, and I'll try to orchestrate this as best as possible. We had a discussion in closed session with NAC members about emerging financial reporting issues, those that are, again, within the board's purview. There was a lot of, there were a lot of things that were, a lot of issues that were raised, some of which were outside of the scope of the FASB. But of the ones that are potentially, I want to just, again, try to summarize those a little bit, call upon NAC members in doing so. There was a bunch of discussion about risks and uncertainties, some of it more specific, some of it more general. Among the really specific things is an issue that Chris Dutch raised, and I'll ask her to elaborate on this just a little bit, about a measurement uncertainty with grants and contracts, grants having to do with the not-for-profit contribution model. This is actually an issue that we first heard of and first were consulted about back in the middle of the pandemic with the healthcare provider relief funds as to whether or not, to what extent, how do you deal with a situation where what you're ultimately entitled to is uncertain? It's not just a matter of meeting conditions, satisfying conditions, and then knowing what to recognize. There is some uncertainties there. And Chris, why not let you, rather than me, come out of my mouth, I'll let you elaborate a little bit here.
Yeah, thanks, Jeff. Yeah, my point there was that some of the recent activity with regard to federal grants in particular, there have been this uncertainty. And even if the recipient has met the requirements, there could be questions around whether ultimately it will be collected, or there could be additional conditions imposed at a macro level that are not related to the grant, and how to take those into account. I think the 958-605 contribution model doesn't really contemplate those sorts of uncertainties. And so my recommendation was to maybe rethink that model and really think about what the consideration should be for measurement and recognition of those grants.
Yeah, I know one of the things, and Rich will remember this, that we were consulted on is whether or not analogy to topic 606 and variable consideration was appropriate. Again, this is not something the board has addressed at all, but that's what you're raising as to whether it's that or something else that we could perhaps, the board could perhaps relook at to deal with this increasingly common situation where there's measurement uncertainty.
Exactly. Yep.
Okay.
So.
All right. So I don't know if anyone had any questions about that before we move on to other things that were discussed. Okay. Then there was a number of things that I guess more broadly fit into uncertainties about risks and uncertainties. I think some of them perhaps being operating risks, some of which I think what I'd like to do here is maybe turn over to Christine. I know you had some observations here, and maybe others as well.
Yeah, I thought we had a really interesting discussion about the adequacy of disclosures around risks and uncertainties, and whether the threshold that is in topic 275 is meeting investors' needs, particularly in the space of private companies and not-for-profit organizations where there isn't a requirement related to MD&A disclosures. And so what I took away from the discussion, just listening to our investor and our practitioner discussion of the existing guidance, is that it is a very high threshold before those disclosures would be included in the financial statements. And the sense I was getting from our investors was that that their need for information is probably at a lower level of materiality, shall we say. And so there might be a role for the board to take a look at the threshold that is used in topic 275 and whether it's at the right level, particularly when there aren't requirements for MD&A.
Okay. I don't know if any of the NAC members who had comments in this area, Andrea or others, that you wanted to elaborate a little bit on that. Okay, go ahead, Robert. Thank you, Robert Dobbins.
Yeah, so I appreciate the challenges in evaluating sort of the risk, the likelihood of it materializing, putting values on, those risks as well. I think from like a user perspective, it's more about identifying the level of exposure, right? So this portion of my business is exposed to this risk, not necessarily placing a value judgment on what the level of that risk is, but it's more of the identification of the risk and its relative importance. So when there's a discrete risk, say like tariffs, or grants, and it makes a substantial portion of your business, it's more of identifying that this percentage, 20% of my business is subject to risk around payment of grants, right? And then I think we can sort of separately assess our risk tolerance around those things, but it's more about breaking out discrete risk.
So you're just saying that, again, you're not trying to, you're saying that there's maybe not enough information to serve as a red flag to highlight for you the kind of things to perhaps ask about? This is the kind of thing we often talk about with our private company counsel, for example. Rich?
Yeah, I think
sorry.
that's it. I think we can get that information directly from the issuers we work with, but I don't think there's an easily accessible way to get that information in audited statements or MD&A, and for it to be consistent and for us to be able to build processes around gathering that information from those sources.
Okay. Rich Jones, then Andrea.
Yeah, just a couple things. There's 275, if I remember, it's been a little while since I looked at it, had a section on concentrations of risk, right? So the significant customer, the union contracts, all those things. And then the risks and uncertainties, which was really a future event. What might be helpful is we consider that if there are examples of those events that have occurred that you didn't see any indication of in a financial that had, some material effect, whatever it is. So anything, any real life examples along those lines, doesn't have to be at the table, obviously, would be helpful to us as we consider that.
Andrea.
So along those lines, the guidance does provide for footnote disclosure around concentrations, maybe by name of funder, maybe a particular, city department or state department that's funding a program. But it does require us to ask, the issuer, the borrower, for more information. There's just not enough information for us to really make an assessment of risk. It might say there's a concentration, but then we'll say, can you give us a list of what's included in the receivables here, or what's included, very specific list by contract, so that we can work with the borrower to assess that risk. What's in jeopardy? What are the expiry dates of these contracts? But these really are unprecedented times where, the expiry date of a contract doesn't matter if the funder can cancel the contract at any time and is doing so. So along what Rich just said, there are examples, and we can, I think some of us around the table can help you with that. Providing some real life examples where a grant was canceled in the middle after a nonprofit hired 100 people to deliver a program, and they're delivering it, and with no notice, a program is canceled. So I think we can help with that, to help you think through how to address the uncertainty going forward of things that we couldn't have foreseen in ordinary times.
And I think a lot of the discussion was that these are far from ordinary times, or seem to be, and that's is there something else that's needed beyond what has traditionally been provided?
So I wondered if, I totally agree with some of what's been said from the users in the room about maybe having incremental information. I wondered if there was, if this was an area where there was a lot of discussion between the auditors and the not-for-profits regarding, whether or if they should be providing more information. Is there tension on this particular point, or just not because of the lack of clarity of information?
Chris, I think you sort of alluded to a little bit of that about, consultations with clients and what really to put in versus not to put into a set of financials.
Well, I think from an auditor perspective, I'm trying very hard to make sure it's something that I can audit. And so a particular risk without, kind of the objective criteria from the standard, I kind of shy away from recommending to my clients to put in. I'd have to assess because I'm associated with that disclosure at this point. I think this issue is also kind of circles around to, the fact that MD&A is not required, right? And so where some of this information that might be more useful to other users would go there and not be audited. I think that's the tension that we feel, which is I'm trying to kind of stay in my lane and be able to audit something and not have too much in the financial statements, although it might be interesting and relevant to others, but it's not part of what's actually required.
Okay. I think I saw Pete, then Carrie, then Rich.
Sure. Similar to Chris, I think sticking to what we can audit is important. I have a social service client who was, wanting to originally disclose that they're concerned about grants that could be cut, almost feeling like they're going to try to make the financial statement their political statement of being concerned. So where they landed was disclosing a significant grant that was canceled during the fiscal year, and they had been formally notified of a subsequent to year-end cancellation. So I told them, I can get comfortable with you writing up subsequent to year-end X grant was canceled, but we're not going to really want to go down the path of we're concerned that these could be canceled or the current environment is, jeopardizing XYZ. So sticking to what we can audit.
Okay. Carrie?
As a preparer, I think that's something that we struggle with is what we're including in our financial statements and what can be audited. So striking that balance between messaging, thinking back to our COVID disclosures and where we were operationally during COVID. And again, wanting to include a disclosure that explained where we were, that then could be turned over to our auditors and they could get comfortable around the numbers that we were including, which included enrollment information that we don't typically include in our financial statements, but to a reader was important information in the context of all the other disclosures that they were reviewing. And so I think this again is going to strike that balance of what do we include to educate the reader. In some instances might fall below the level of materiality that we would typically see in our statements, but it's important for the reader. And so I think we have to sort of on almost a disclosure by disclosure basis, think through what is that balance, but it's going to, and then I think not having comparability across the sector in what we choose to disclose could create challenges for the readers. So it's really striking a careful balance across all of those considerations.
Thanks, Carrie. Rich?
Yeah, just listening to the conversation and then going back to the original comment on revenue recognition, I guess I'm just trying to understand, are these contracts that are legally cancelable, or there's uncertainty about the ability to legally cancel them, and that uncertainty will likely be resolved through some process? Because if you told me it was a cancelable contract, my guess is there's accounting for revenue recognition with cancelable contracts, just like there's accounting for contracts with fiscal funding clauses and other things. If on the other hand, you tell me, well, we're not sure if the counterparty is complying with the terms of the contract, and if it gets canceled, you're going to have this painful process of trying to recoup what you're owed under the contract. I mean, we have that commercially all the time. So I guess I'm just trying to understand, is this really just more of a period where either people figured out they had cancelable contracts and didn't know it, or they're not sure they're really cancelable, but there's got to be a legal process to figure it out? Because if they were cancelable and they just didn't know it, you kind of wonder, well, shouldn't you have been accounting for them as cancelable contracts all along?
Yeah. From my perspective, Rich, it's more of the latter. right? It's not clear whether they're cancelable or whether they were canceled under the right contract terms. And so there is a process that plays out. And I guess my point is that, yes, 606 has a framework for how to think about that. And the contribution model does not. So we are using 606 concepts, by analogy. But, we're doing it by analogy, and the 605, the contribution model doesn't really have a lot of that framework built into it.
Yeah. Anyone wanted to add anything to that? I know, Carrie, you had your sign up briefly.
I would just say that they are, what we are seeing is that they are not being canceled because that we missed a cancellation clause. They're being canceled by executive order. And so we're sort of going on a case by case basis and then determining sort of what the rev rec needs to be with respect to that and the ultimate collectability and the status of whether there are TROs attached to that. And again, collectability.
Okay, thanks. Anything else in this area of risks and uncertainties before we move on? Go ahead, Andrea.
I think you make a great point. And in human services, for example, we're used to the reassignment of a contract to a different agency if an agency isn't delivering services up to a certain standard, perhaps, or maybe financially they're not viable. So those contracts get reassigned to a different agency. So there's continuity of services. So I think that the stakeholders in the industry, we're not used to cancellation of contracts. We're used to reassignment and things like that without disrupting recipients of services. So this is new territory. And honestly, I have not looked at a lot of these contracts up close to see, well, gee, was this cancelable? And to Carrie's point, they're not being canceled per their terms. They're being canceled sort of outside of the norm. So more to come, I guess. I mean, we're going to muddle through this and figure it out, but I just did want to speak up and say, yeah, we're used to change, but not this kind of change. So we're figuring it out as we go, and I'm trying in this context to figure out how we can, continue to rely on the financial statements and move forward in the businesses that we're all in and the different stakes that we have in the industry, in the face of this change.
Okay. All right. Maybe a more narrow topic is, I know, Ksenia, you had brought up differences in practice out there on cash flow classification having to do with programmatic loans as either operating or investing, the inflows. And if you want to just elaborate a little bit, or maybe it was Ellen, both, I think both of you.
Yeah, that was my comment first.
Sorry.
And then expanded upon. So I am seeing some diversity in practice as to the presentation of the inflows and outflows of programmatic loans on the statement of cash flows. Some instances where it's being treated as investing, which seems consistent with the definition in the glossary of investing, which says loans. But then I see instances where it's presented as operating, and the basis there seems to be that programmatic loans don't exist for the production of income or adding value. They exist for mission purposes. And then if you read further in the definition, it does allude to the fact that investing activities would be to produce income ultimately for the organization. So just a suggestion that there be education or clarification.
Okay. Okay.
Yeah, and my comment around cash flow statement was more surrounding endowment cash flows, whether or not they should be presented net versus gross. We're seeing that discrepancy in practice. I would probably even say that some of the perhaps movement of restricted cash could be also looked at in terms of what's considered of operating versus not cash held for long-term purposes. We're just seeing, especially whether it's through some internal inspection or reviewing other firms, but within the firm as well, just variances on how that cash flow statement is presented around different activity.
Okay. And we do have a research project on the statement of cash flows. So again, that could be suggestions towards that. Then finally, in my last couple minutes here, there were a couple of things that were brought up that bear upon, in one case, a research project that we have on digital assets, and then another case on one of the things that was raised in the invitation to comment. The digital assets thing was, Robert, you had brought up that you're seeing more so in the governmental sector, but maybe a little bit in the nonprofit sector, stablecoin payments, and some questions therefore arising as to, are these cash equivalents or not? And if you want to elaborate on that.
Yeah, I would say that, there's, ever increasing broader acceptance of crypto, but to maybe delineate stable coins from more investment-based crypto, right? And so that's where I was asking for some potential guidance on, whether stable coin would be, cash equivalent or something separate from, an investment-based crypto. So I know that's something that we're doing our own research around, sort of different characteristics of that from a liquidity perspective, market access, market volume, and just sort of like the custody arrangements behind the fiat currency that back those assets. And so it's just, sort of presenting that to you to maybe think through that yourselves.
Okay, thank you. And the other thing I mentioned was, this is related to one of the issues that was raised in the invitation to comment, which was about the various definitions of public, some of which encompass not-for-profits, some of which do not encompass, or at least certain non-for-profits. And I guess the members are saying the pressure that was putting on those not-for-profits who are seeking capital financing in terms of the in some cases much higher, but it's topic by topic level of disclosure that those not-for-profits are considered public are subjected to. I don't know whoever was raising that issue. Let me just see if I check my notes real quickly. Could talk about that. I think Ksenia, you may have been one of the people mentioning that.
I just mentioned that something maybe whether it's an educational resource or whether the guidance should be looked at from the standpoint of clients shifting, especially if they issue bond financing through and become either a conduit bond obligator or just directly through public offering, where their financials shift in disclosures and having to go through standards, specifically trying to understand the reporting requirements now under two different frameworks in a way. So fair value disclosures, lessee disclosures, and revenue recognition. Those are kind of the top three things that tend to change within the disclosure requirements. So just something to think through.
Okay. All right, before we move off of the public report out here, is there anything that anyone, especially online, wanted to raise here? Anything we didn't cover, thought that we should be emphasizing in this public report out? Okay. If not, thank you, everyone. And I'll now turn to our patiently waiting agenda consultation staff. And those are Erica Friend, Tiffany Wiskowski, and Alicia Manders. And I think, Tiffany, you are leading us here.
Thanks, Jeff. We can move to the next slide. In September of 2024, we met with the NAC as part of the kickoff process of the agenda consultation process, where we asked members, what should the board work on next? That discussion was part of a broader outreach effort that we performed during the second half of 2024, which included talking to a cross-section of over 200 stakeholders. And that feedback created the content of the 42 topics included in the invitation to comment that was issued in January of this year. The comment period ended on June 30th of this year. And if we move to the next slide, this highlights that we received over 129 responses in relations to the ITC, which included feedback from comment letters, stakeholder outreach meetings, and advisory group meetings that we held through the end of August of this year. You can see from this pie chart that it came from a cross-section of stakeholders, which included investors, preparers, practitioners, trade groups, and others. And these stakeholders represented a wide variety of industries such as financial services, pharmaceutical, oil and gas, energy, and crypto. On the next few slides, this will give you an overview of the feedback, but this slide highlights some select topics that are included in the agenda consultation ITC and the percentage of respondents that identified each as top or low priority. There was a wide range of perspectives across topics. While some topics were consistently identified as top or low priority by stakeholders, other topics received a variety of responses with views split between top and low. And also, even when topics were consistently identified as top priority, the feedback was often very diverse on how the board should address issues in those topics. So for example, risk management and hedge accounting and outdated disclosures were identified as top priorities, but stakeholders provided numerous suggestions on how the board could improve matters related to those issues. So if we move to the next slide, this highlights the most frequently identified top priorities by investors, preparers, and practitioners. As you can see, there's differences in views among the three groups about the topics that the board should address. Investors and investor advocate groups primarily identified issues related to enhancing financial reporting information as a top priority, while preparers and practitioners primarily identified topics related to making targeted improvements to GAAP to reduce unnecessary cost and complexity. And if we move to the next slide, many of the topics that the NAC identified as top priority in March of this year received mixed feedback from stakeholders. This included enhanced disclosures, the statement of cash flows, KPIs, and the definition of PBE. The interaction with the consolidation guidance and other topics generally received more support from stakeholders, but the majority of that feedback was related to asset acquisition and business combinations. Stakeholders generally agreed that below market and interest-free loans from donors should be a lower priority for the board. I'm now going to hand it over to Erica, who will take you through the chapters, and we'll touch on each of these topics in a little bit more detail.
Okay, thanks, Tiffany. Good morning. So the ITC was organized into 8 chapters. If you saw you'll see that 8 chapters. We had the 42 topics, as Tiffany mentioned, and the feedback was really grouped into topics within these chapters, so similar topics within each chapter. So chapter 1, you can see is combination of entities. So this provided kind of a wide range related to combination of entities. You can see that we've identified on the next few slides that I'll highlight a few things that we've designated top, low, and neutral. I think top and low are self-explanatory. Low includes those that said, this should not be a top priority or should not be addressed at all. Whereas neutral includes things that, stakeholders were open to standard setting and may have provided suggestions, but it's not the highest priority. So starting with chapter 1, equity method of accounting received really the highest volume. This included topics related to really all kinds of combination of entities, consolidation, equity method, and business combinations. Equity method, as I said, received the highest volume of feedback, but there was mixed feedback within there of whether it should be addressed, and if so, what should be done to address it. And Tiffany highlighted the interaction of consolidation guidance and other transactions. This was frequently identified as a top priority, and this was mainly due to looking at business combination and asset acquisition guidance and looking at the diversity in practice and differences in transactions being accounted for differently. Moving on to chapter 2, this included a wide variety of topics related to all things financial instruments. Here, risk management and hedge accounting was really a very high priority among stakeholders, but they did provide mixed views on how the board should address it, as Tiffany mentioned. Below market and interest-free loans from donors was generally identified as a low priority, which is consistent with NAC's feedback that we received in March. Stakeholders here noted that this is generally not a pervasive issue, and when challenges arise, it's really related to facts and circumstances for the specific transaction and not the complexity or challenges with the guidance itself. Moving on to chapter 3, this included a few topics related to intangibles. Here, addressing the accounting for crypto assets beyond what the last crypto project did was really the top priority for this chapter. And related to this, there was a research agenda that was added after the issuance of the ITC that will explore target improvements to the accounting for and disclosure of certain digital assets and related transactions. And for multi-element software arrangements, the last one there, it was generally identified as a low priority. Stakeholders observed here that there's not a ton of diversity in practice or challenges with allocating costs across these types of arrangements. However, for those that identified as a top priority, did note that there are some challenges in this when the vendor is unwilling to provide the information that is necessary, and that there could be some simplifications done to this guidance. The next chapter, chapter 4, included kind of a compilation of other assets and liabilities that weren't covered into other chapters. Here, the definition of cash equivalents, which Robert just touched on, a good amount of this feedback was related to stable coins that Robert just mentioned. For chapter 5, this was a few retirement other employee benefit related topics. These topics were generally listed as a low priority by stakeholders in their entirety. And then chapter 6 was income and expenses. And mostly of these were really revenue related topics, with the primary topic that was priority here was principal versus agent considerations. And stakeholders noted here that this area continues to be challenging, especially for platform entities. And the rest of the topics within chapter 6 were generally identified as low priorities, but stakeholders did provide some suggestions for the targeted improvements the board could do. Chapter 7 was really related to improving presentation and disclosure of financial reporting information. A lot of feedback here that we have received from users leading up to it. Here, enhanced disclosures and outdated disclosures, you can see received a high volume of feedback. And I would say this was very split between type of stakeholder. So while users generally agreed that the board should enhance disclosures as a top priority, with a very wide variety of suggestions on what disclosures should be enhanced. Conversely, preparers generally agreed the board should actually not add any incremental disclosures, but rather revisit outdated disclosures and see if any current disclosures could be reduced or eliminated, such as derivative or fair value measurement disclosures. As it relates to the definition of a PBE, which Jeff just mentioned, stakeholders were generally neutral on this priority and noted if the board were to pursue a project, there could be a few things they could consider, such as revising the definition to exclude certain entities like bond conduit, bond obligors from the definition, or stakeholders highlighted that there was a lot of variations of the definition of public and private entity in the COD, and that the board could consider eliminating some of those definitions. And then the last chapter included current research agenda projects, some of those that were just touched on, like statement of cash flows. And these really just asked for some direction and paths forward for these topics. For the statement of cash flows, this received mixed feedback from stakeholders. Although users generally indicated that this should be a top priority to improve the usefulness of the statement, there was generally diverse views on how the board should address that and how to improve it. Preparers noted that they did struggle with applying the guidance, which leads to diversity in practice. And in general, there was a really wide range of solutions the board could consider, from target improvements to more broad suggestions. And then as it relates to the financial KPIs topic, stakeholders said that KPIs are pervasive and there's a lack of consistency. However, it could be challenging to identify how to define the KPIs and may be better left to management. Separate from financial KPIs for business entities, which was the question here, NAC and an NFP respondent did suggest that the board define an operating measure for NFPs, which I know NAC has discussed in the past, given its diversity of practice, lack of comparability, and increased scrutiny on all not-for-profits related to this. And so that kind of gives you a really high-level overview of what all the chapters were and touched on some feedback. This slide, which I will not go through in detail, really is just all of the topics that you can see. And so this chart really demonstrates the high volume of feedback they were received and also the diversity of that feedback. Go through it at your leisure for your favorite topic. So to give you a preview of next steps, tomorrow there will be a board meeting to discuss feedback from the ITC. And this is really just kind of a kickoff to talk about the feedback, and then the board will analyze all the feedback, bring back all of the topics against its agenda decision criteria as part of an overall agenda prioritization process, and decide what topics they would like to add to the research and technical agendas. And then once the board has completed analyzing the feedback received throughout 2026 and the end of this year, there will be an agenda consultation report issued that will summarize the feedback and how the board took that feedback into account to shape its standard setting process and its agendas. And so with that, we'll now turn it back over to Jeff if there are any observations or questions that we just went over.
All right, thank you. So these are just any questions about your report as opposed to we're going to then go into breakout groups and actually discuss this a little bit. Any questions for Erica about what she just reported out and what Tiffany just reported out? If not, Jeff, tell us about our breakout groups.
Okay, thank you, Jeff. So we are going to have breakout groups now from 11:20 to 11:55 a.m. Those groups are private meetings and they will not be recorded or live streamed. Audience members may rejoin us at 12:55 p.m. after the lunch break. There's one discussion question, as you see on the slide. Do you have any initial observations or questions about the stakeholder feedback received? The most recent version of the assigned groups, which was the same, it's essentially the same as the one you got last week, is around the table with both in-person and virtual participants. For each of the groups, there will be one NAC leader who will be asked to provide a summary of the key takeaways when we reconvene this afternoon. And then I will give instructions about getting to the rooms in a moment. After the breakout sessions, we will reconvene for a full report out at 12:55 p.m. Are there any questions before we close out the live stream?
And again, a key thing there is that you guys online don't need to do anything. You'll be
Yeah, I'll explain. Yeah. Mm-hmm. All right. So yeah, we can close out the live stream and then I'll give you the room instruction.
Welcome back to our public meeting of the Not-for-Profit Advisory Committee. Before we had lunch, we had some private breakout groups just giving their reaction to what staff reported out on in terms of stakeholder feedback to the invitation to comment on agenda consultation. We'll now do report outs and have a little bit of a discussion. We'll give 5 minutes to each of the 3 breakout group leaders. I guess we'll do it numerically. I'll start with J.R. Miller, who'll report out for group 1.
Okay, thank you, Jeff. So our group had a lively discussion on the agenda, and basically, yeah, there was a wide disparity when you look at the enhanced disclosures. There were quite a few with low priority and quite a few with high priority. And what really started our discussion was we thought investors and preparers weren't on the same page in terms of investment disclosures, in terms of basically the investors wanting more information or enhanced disclosures, and preparers also, in some cases, feeling there's a lot of disclosure there. But we also started to have a discussion around maybe there should be the breakout again of realized and unrealized gains. That is something that we all find we're either being asked that question or something that we're going back and trying to pull apart as we're analyzing our own financial statements. So that was something that we certainly discussed quite a bit. And then the discussion moved on to around cash equivalents and being the breakout there. Chris had some comments around cash equivalents, and we talked a little bit about what are the cash equivalents, whether they're investments, whether they're part of cash. And it's not always clear how that breakout should occur. And then it evolved into a discussion around the categories of net assets. We talked a little bit about around that in terms of the 2 or 3 categories, and then we've collapsed it down to the 2 categories. But oftentimes, as preparers, we're keeping track of the temporarily restricted and permanently restricted net assets, and then reporting it externally as combined. And there could be some possible enhanced disclosures around providing some more visibility on the composition of net assets. We then went into discussion around the uncertainties, further discussion on what we had already talked about this morning. And especially if it's federally funded type grants, the issues are kind of coming in client by client, and we debated what level of disclosure is even possible. Certainly the aspect of concentration of disclosure is very important if you are significantly federally funded. And then we got into another discussion around the consolidation of entities and the complicated arrangements that are becoming more and more prevalent within the nonprofit sector. And so those are the 4 areas. I would open it up to the team to say, is there anything deeper in the discussion that anyone would like to pursue there, or even amongst the other council members, if there's something there that overlapped with your groups or you had further discussion on?
We'll get to the report out on the other 2 groups in a moment, but I wanted to see if any of the other members who were part of group 1 wanted to add color to what JR said.
Mm-hmm.
Anyone online as well? Okay, if not, I'm sure we're going to be doing a little bit of comparing and contrasting with the other 2 groups. So let me turn to Pete Hugo, who's going to talk about the group that I was part of.
Okay, thanks, Jeff. Our group had a great discussion as well. I think I would summarize the general reaction. We focused our conversation on the slide that had the NAC priority areas, so the 6 areas that were listed that had the most not-for-profit responses. And I think the general reaction was there were not a lot of surprises in those being the top categories commented by the not-for-profits. One that we spoke briefly about was definition of PBE and just of interest to not-for-profits, mainly because of effective dates of standards, more so than varying differences in financial reporting under those 2. But most of the conversation was around just the overall concept of wanting financial statements to be helpful to a reader to understand risks and financial performance. So under that sort of heading of just being clarity to the users of the financials, whether you are a rating agency, a grantor, or whatever it is, disclosures are certainly of heightened interest to most. But we definitely were not surprised that there's a wide range of responses that came back on those, because everyone, depending on your perspective, sort of has your own desired enhanced disclosure that you would like to see. So just clarifying some of those disclosures, or thinking through, are there things we should be potentially disclosing more of and maybe less about something else? From a disclosure standpoint also, we just discussed that it's especially helpful when they are tailored to specifics of the organization rather than feeling somewhat boilerplate, like we see sometimes in a few cases. We talked about the statement of cash flows, and a comment that I thought was great that was made, and feel free to expand on this if you'd like, was just that from the user perspective, I think you said where there are options, it makes it hard to create consistency in how you evaluate. So for example, if some use indirect, some use direct, that makes it harder to look at big picture of comparing organizations to each other. And we talked about, as the auditors in the room, generally very small percentages who use an direct method. We spoke about risks, and is there a way that users could be able to see more information in the financial statements about risks that auditors are able to audit? An MD&A would be where some of those things could occur, but that's not a requirement and not something we see widely used. One specific example was around disaggregation of revenues. Oftentimes you see a grants and contributions line. So we had a pretty lengthy conversation about, is there a way you could disaggregate that to give a reader more detail of exposure to government grants separately from private grants? That led to a conversation about, obviously you need to maintain confidentiality. You're not going to get down to such a detailed level, but that could be one area to help you understand exposure that the organization may have to revenue risks. We then wrapped up by the age-old topic of operating measures. And is there something there? We sort of spun that to the concept of an operating, non-operating section that many not-for-profits use. And there's not a lot of required guidance on what goes in or out of operations. So should that be maybe something that is considered, rather than trying to define an operating measure, perhaps refining that a little bit of what's in or out? So those are my comments. And if anyone else from our group 2 wants to add anything, feel free.
Anyone else from group 2 want to add color to what Pete said? Anyone on virtually? And we have 3 members on virtually. Okay, not, all right, let's go, Jen, group 3.
Great. So quite a bit of overlap, so I'll try to be as concise as I can, but we began our discussion as it relates to disclosures. No surprise that there was wide support for enhanced disclosures as well as on the preparer side to try to streamline it down. On the enhanced disclosures, I think the areas that we discussed being more helpful to expand might be around contract revenue and liquidity, as the lenders find the liquidity footnote at sometimes is not as useful as the information that they need. And we also spoke about breaking out realized and unrealized gains and losses. On the preparer side, I think at this point, in some cases, financial statements, and I think Carrie shared this, hers are over 100 pages long. So at that point, I think the preparers feel, is it all useful? And perhaps there's an opportunity to streamline that. The other area that we spent some time on had to do with consolidations and business combinations. And I'd say the headline there is that sometimes the result is not the intention or the spirit of the transaction. So you could end up with a consolidation decision that was not the intention. We see that sometimes with investments in limited partnerships. And we also agree that the transactions and the type of business combinations and sort of consolidation considerations has gotten more complex in the not-for-profit space than it was probably when the guidance was developed. Additionally, the other aspect of consolidations that we spoke about is that the guidance can be really tricky to navigate. Obviously, not-for-profits don't have VIE guidance, and depending on the type of not-for-profit organization you are, you could walk through that, what we call decision tree, and get to different answers. And so that could be confusing to preparers and even in some cases to auditors trying to navigate that. So we believe there could be some opportunity to streamline that or tighten it up a bit. The other item, I was actually going to pass it over to Brian as it relates to asset retirement obligations. We recircled the wagons on that a little bit, particularly as it relates to healthcare. So I don't know, Brian, if you don't mind just sharing briefly our conversation on that topic.
Sure, I'd be happy to.
Oh, I'm pointing the wrong side. I have my reading glasses on. I'm sorry. I'm pointing over here, JR. Forgive me.
Yet.
I can't see past my nose here.
Yeah, so we had mentioned one of the things that piqued our interest, piqued my interest, was asset retirement obligations and the invitation to comment. We see this more often on the not-for-profit healthcare side and maybe a little bit on the higher education side. But I had commented I haven't seen it as much recently. I don't know if that was a diversity in practice kind of thing, or if it relates to the indeterminable useful life exception that was mentioned in the invitation to comment. Or, is it an environmental thing where, in healthcare and higher ed, you're just not seeing as many buildings with asbestos in them. And so you don't have the liability. And this is really more of an energy or a waste management narrow standard. But in discussing that, we had the discussion where, regardless, I do agree. Well, I don't know if we agreed that fair value measurement wasn't the right measurement, but I think we did agree that it's a complex measurement, that you could end up with the situation that was mentioned in the ITC, where you've got gain on settlement, and it's for most organizations that are going to be doing this analysis internally, it's a tougher number to get to. And a liability based on, present value of future cash flow, something like that, may be more useful and easier to get to and consistently applied.
Thank you. Oh.
Yeah, I just wanted to follow up on that because it's an interesting point. We hear about this indeterminate life. It tends to be focused on oil and gas infrastructure. But if I hear you, and it's a good point, if we were to tell a college and maybe an Ivy League school that they needed to provide an ARO for all the asbestos in their building, whether that would seem to be an interesting consequence. So is there a view that these infrastructure heavy not-for-profits likely would have to go on almost a hunt for these types of liabilities if that indeterminate life exception was taken away?
I think Yeah, I think that would be, and again, I think that's since the guidance originally came out in those environments, that's changed. It used to be, those infrastructure heavy organizations that were working with a lot of aged facilities, had a lot more asbestos exposure, and so the liability was potentially more consequential. If that was the only area, like you say, you see this a lot in oil and gas, if that's the only area that would fall into this category of a legal obligation at retirement, would be asbestos, I think the organizations might be in for an Easter egg hunt over something that's potentially not significant.
As well as the costs of disposing of any other component of those facilities.
But I do think that the indeterminate useful life might be used in that situation. I don't know that that's appropriate. I mean, most of the assets we're talking about, you should be able to determine the useful life. They're depreciable assets. And I don't know if that's different in oil and gas, where you have assets that are harder to determine the useful life.
Yeah, I guess it's indeterminate life versus depreciable life, right? And that's where we always run into this issue that, the Empire State Building, right? If you bought it today, you'd assign a life to it.
Right.
But I doubt, and that would be a composite life based on all the components. I doubt anyone would say in 40 years they're going to tear it down and have to dispose of all the components, particularly since, it's probably a landmark, right? And you probably can't do that.
Good point. Fair.
Okay, thanks.
Chris?
Great. Yeah, I guess just Rich, thinking about your question with these asset heavy universities, I think that question of the indeterminate life was settled 15 years ago. And I think that for the most part, all of them have some level of asset retirement obligations booked because they did go on a hunt for those obligations back then. So even the Ivies and any other university that has long-lived infrastructure who never intends to tear it down, they generally do have some sort of accrual already for something like that.
And just from a higher ed perspective, confirming that we did go on a significant hunt to implement the obligation and that we updated every year based on what remediation has happened, as well as looking forward into our capital plan and the remediation plans that we have there. So there's a perpetual touring of campus and maintaining of where lead-based paint, asbestos, even tanks underground that could be there. So we're really touring campus, yes.
And then the likelihood of actually doing it or not, you put it in the
Well, that's
fair
where our
value.
capital plan comes into.
And you put that in the fair value.
Yes.
The probability, right?
Right.
Okay. We also spoke about operating measures and determined that it's highly unlikely that we'll find one set of KPIs that would work across the sector, given how different all not-for-profit organizations can be. We also had general wide support for revisiting the public entity definition, and it creates quite a bit of confusion. And then the last item that I'll mention is we talked about the complexities with the fair value option of other investments, as well as the complexities with the equity method investments. And I don't know if Kinzia, if you want to talk a little bit about the issue on other investments that you raised.
Yeah, we just had an interesting discussion that came up in my practice of valuing mineral rights depending on how the not-for-profit acquires them, whether if it's through a contribution and they actually have a title to, let's say, oil and gas mineral rights, and they choose to not elect fair value, versus if mineral rights are held as part of the beneficial interest and the trustee is who holds the title. And we've run into situations where the trustee on their statements would show that the assets of that trust include mineral rights, but they don't fair value them. They just show them as $1 per well, for example. And so you have this diversity in practice where one not-for-profit could be carrying the same exact asset per se at in one framework versus the other. And how hard it is to value some of that for smaller nonprofits.
And that's a wrap.
All right, that's a wrap. Any feedback from anyone around the table to what you just heard? There's obviously a fair amount of similarity in the report outs and some differences. How about those of you who are online? Anyone? Anything from the agenda consultation team? Anything you want to tease out here at all?
No, I don't think so. Just thank you for the discussion today. We really appreciate it.
All right. So let's move on then. Okay, so we now are moving into another research project. This is the Accounting for and Disclosure of Intangibles research project. And we'll wait for the team to switch out, other than Erica, who is staying, right? And joining Erica are Katrina Popel and Jill Switter. And Katrina, I think, will be taking the lead, and we'll give her a chance to settle in whenever you're ready.
Thanks you all for having us. Hopefully my mic is on. During this particular part of the session, we're going to talk about intangibles and specifically the feedback that we received on the intangibles invitation to comment. So if we go to the next slide, this is a slide that we've talked with you all about before. It highlights the journey the board has been on as it relates to intangibles and some of the milestones from the project. And last time we connected with you all in March, the ITC was out for public comment, and the board received 43 comment letters on the topic and met to discuss that feedback on September 24th. This next slide is just a reminder of the purpose of the ITC. It was issued to solicit broad stakeholder feedback on whether the board should pursue a project on intangibles or not. And then on the next slide, we have some of the key takeaways from the invitation to comment feedback that we received as well. The main feedback being that, or main takeaway is that stakeholders' views on intangibles continue to be diverse. And consistent with feedback that we've heard in the past, comment letter respondents did provide mixed views on whether the board should even pursue a project on this area, and if so, what types of intangibles should be addressed and how those issues should be resolved. And only one respondent supported a broad reconsideration of the accounting for all intangibles. Most provided feedback on whether and how the board should align the recognition criteria for acquired and internally developed intangibles, but their views were mixed on whether the board should align that recognition criteria, and if so, how they should do that. And then we did receive feedback from several respondents that the board should consider enhancing disclosures related to internally developed intangibles as well as research and development. And many of those suggested disclosures involved the disaggregation of certain amounts in the financial statements. And then just last on this key takeaway slide is that several respondents provided suggestions for targeted improvements to intangibles as well. And then as it relates to research and development on the next slide, there were questions in the ITC related to the definition of research and development, as well as the accounting for research and development. And again, here, the feedback we received was mixed. As it relates to the definition of research and development, some said that the definition is insufficient because of modern innovation, and some recommended updating the examples of research and development activities that are in the codification. And then as it relates to the accounting for research and development, some supported the current expense model, whereas others supported capitalizing development costs. And then just last year on operability and auditability, there were some respondents that indicated that judgment is required to determine which activities are considered research and development, but generally there are no issues when they're exercising judgment in that case. And then on the next slide, as it relates to internally developed intangibles, we did have a few questions in the ITC related to the recognition of these. And overall, there was little support for the board to take on a project in this area. And then on the next slide, this was the topic that was most commented on in the ITC. And we had some questions on whether the board should align the recognition criteria for acquired and internally developed intangibles, and if so, how that should be done. But again, we received diverse feedback and generally no consensus was reached on this area. Of the respondents who did support or provide feedback, a majority did support alignment, and they supported different levels of alignment. So some supported aligning just acquired intangibles, and some supported aligning acquired IPR&D, and others just recommended a holistic alignment of the acquisition models altogether, so higher level than it just acquired intangibles. And then on presentation and disclosure, we received diverse feedback again. Some respondents suggested disclosures related to internally developed intangibles and research and development, but many of them focused on disaggregation of information. And they also suggested that the FASB consider work that was done by the CFA Institute as well as the FRAG. And then from an investor standpoint, respondents indicated that investors are routinely making pro forma adjustment for amortization and impairment expense related to acquired intangibles, but most investors are not actually supportive of accounting, changing the accounting requirements to accommodate their particular adjustments. And they also support the current accounting requirements for research and development costs, but they did suggest enhancing disclosures in some areas, like for internally developed intangibles, acquired intangibles, as well as research and development. But based on feedback that we received, it doesn't seem like they're interested in anything related to internally developed from an accounting perspective. And then there were several other targeted improvement areas that were suggested by stakeholders, and those related to accounting for acquired IPR&D, accounting for goodwill, and some other areas of diversity in practice. And just before we jump into the question on the next slide, I wanted to provide you all with a quick update on the board meeting that occurred in September. So during that meeting, the board generally agreed that a one-size-fits-all approach doesn't work for intangibles. And they did provide some feedback on where we should focus our future research. And that was on the definition of research and development and related disclosures, acquired intangibles, as well as advertising expense. And the board is going to consider the feedback from the Intangibles ITC in conjunction with the Agenda Consultation ITC to determine if a project on intangibles should be prioritized, and if so, what that project scope and objective should be. So that brings us to our discussion question. And whether you all have any feedback on or questions on the feedback that we received, or additional feedback for us to consider. Thanks.
Well, thank you, Katrina. And just wanted to see what sort of feedback NAC members wanted to provide here in this very diverse set of feedback that stakeholders gave us. Anything different that from a not-for-profit perspective? I guess not. Let me just check. Let me just check with the folks who are online. Anyone wanted to provide any feedback here? All right. If not, stay tuned, everyone, and we'll be hearing more about this in the coming months, coming meetings. Thank you, guys. All right. So we're now moving on to topic 4 and waiting for the next group to come in. And that'll be our application of topic 715 to market return cash balance plans team. Here they come. Oh, here comes the team after them, actually. Okay, here's our application of, yeah, Mary, we're up to you guys.
just waiting for the rest of the team.
Yeah. So this is Mary Mazzella, one of our assistant directors, and we're waiting for, here's Lucy Chang and Michael DeMarco when he arrives. Michael will be leading us, so we're waiting for him.
Maybe if we play the Jeopardy theme song, he'll be here.
Here, Michael. All right, here's the man. Oh, it's okay. Yeah, we wrapped up the previous topic a little early, so thank you. All right, so I've introduced all three members, and Michael will be, when he gets a chance to settle in, he'll be leading us here.
Yeah, so next I'll provide an update on our project on market return cash balance plans. Feedback received suggested that the accounting does not reflect the economics of these plans, primarily due to the requirements around selection of the discount rate. I'll take you through some of the details on the current guidance and recommendations from the EITF. This slide covers the current guidance for cash balance plans and the EITF project. According to the topic 715, a cash balance plan is defined as a benefit plan, is a defined benefit plan, and communicates a participant's benefit through a hypothetical account balance, which is accumulated each period through principal credits and interest credits. The principal credits are usually determined based on the participant's service or pay. The interest credits are then applied to the participant's account balance based on a fixed or variable rate. The projected benefit obligation for cash balance plans is measured based on various assumptions in accordance with the guidance for defined benefit plans. One of the assumptions is the assumed discount rates that reflect the rates to effectively settle the pension benefits. Noting that there could be different views in practice, the EITF added a project earlier this year to address the measurement of market return cash balance plans, with the variable interest credits are based on an investable market return. At its September 2025 meeting, the EITF recommended that the board add this project to its agenda and make the following recommendations, which we'll cover on the next slide. The EITF recommended that when measuring the benefit obligation for certain cash balance plans that would meet the criteria listed on the slide, the discount rate be equal to the assumed interest crediting rate with no additional disclosures required. The recommended changes would be required for all entities and could be applied either prospectively or retrospectively with early adoption permitted. On the next slide, there are 3 questions we would like to seek your input. The first 2 questions are for preparers and practitioners on your observations of market return cash balance plans or plans with similar characteristics and the related accounting and practice. The third question is for investors on the areas you usually focus on in analyzing cash balance plans. With that, I'll turn it back to you, Jeff.
Or things like it. Brian, thank you. Brian Connor.
Yeah, so on the first question, so I guess the first question in the first question, we do see market return cash balance plans. I don't know if they're common, but they're not remote. The measurement alternative recommended, and as I'm just thinking about this, I don't know that would better reflect the economics. It seems like that would maybe be a simplification to use one interest rate, but I'm thinking about other defined benefit plans. You would still have, those plans would have a rate of return that's going to be different than the settlement rate used to measure the liability. Now, granted, that rate of return is not being hypothetically credited to individuals' account or participants' accounts at each reporting period. But then to treat these plans differently, I don't know if that's better economics. I actually do have at least one plan that has defined benefit plan that has multiple features. So it has a traditional defined benefit, and then it has a separate cash balance feature that participants could opt into. Might be curtailed. I don't know how that would be treated if you had plans that had both multiple features like that.
Michael.
Yeah, and I think that's where that B component of the conditions are, where that subset of the plan
It have to
would
be that. Yeah.
would fall in there, because we've heard that there is sometimes where, and maybe not exactly the same case you referenced, but it's more sometimes you have the traditional benefit plan, you freeze that, and then you move to the cash balance plan. So that was that B condition was meant to capture. And from a economics, what we've heard is, because especially if it's the return on plan assets, where that interest crediting rate is almost self-funded if you fully funded that principal credits. That's why they're saying, well, if you fund principal credits fully and it's tied to the return on plan assets, there really is no unfunded outside of maybe some actuarial assumptions. So that was the argument why it's the economics are reflecting, aren't always reflecting if that discount rate is not different than the interest crediting rate.
Yeah, so for the broader question on other types of defined benefit plan with similar features, EITF did have discussion on that. I think their recommendation is go with a narrow scope, but include a question, suggesting the board include a question in the Explorer draft to see whether there's other types of DB plans should be considered. Yeah.
Go ahead, Rich.
Yeah, and I have to admit, once we get into this topic, gets confusing in a hurry because we're not talking about the assets in the trust, right? We're just talking about you have to project out a benefit obligation that's based on a return on plan that is based on this hypothetical return. And should you be growing the benefit obligation and discounting it at the same rate or at different rates? That's kind of the way I look at it. It's because the theory is that account will grow based on the return of that group of hypothetical, the market return. So should you really be using different rates to grow it and discount it? Or should you be using the same one? The plan assets will still be at calculated value, which is fair value with a corridor right over a period of time. They'll still be at that amount. So it's really only the benefit obligation. And it's a question of if you're projecting it to increase based on return on assets, should you discount it back at a similar rate or a different rate? And right now there's a disconnect there.
Not sure. Okay.
A quick follow-up. So it's interesting because GASB in accounting for their defined benefit plans uses the same rate. The investment return rate is the discount rate, and that's kind of a funding over time model. Whereas you mentioned using a settlement rate, a rate that you could take out the plan with an annuity-based product or whatever, is a different model. And so on these plans, would you, just for these plans, using the rate of return as opposed to a theoretical settlement rate? I mean, I guess I'm trying to process what you said about the principal credits, but that's what I'm wondering on those subset of plans. Are they that different that you would use the return rate?
And I think that's really the distinction here, right? If you kind of think of the spectrum of defined contribution versus defined benefit, I think that this is somewhere in the middle, right? But we call cash balance plans, EITF determined that cash balance plans a long time ago were defined benefit plans. So the way of addressing the kind of challenge that was identified by the EITF is really to look at the discount rate. But I think that's partly because it feels a little bit like a defined contribution plan, but we are in the DB plan accounting and not trying to make a fundamental change to it. So I think it's more of within this narrow scope, and I think that's why the EITF really was thinking about it on a much more narrow basis. In these circumstances, since they do have kind of this tie back to the asset, the plan assets, is that a better reflection? And does that end up providing more decision useful information in I would say, a measured way rather than kind of fundamentally relooking at, because that was one other alternative, is we could fundamentally relook at defined benefit plans. But certainly I think for EITF, for purposes of it, just keeping it narrow and focused with regards to these specific types of plans, I think is really the key.
Okay. Anyone else have any input here on those first two questions? Practitioners and preparers. All right, Michael, why don't we turn to our users for the third question?
And this is really just what areas do you usually focus on when you're analyzing cash balance plans?
Okay, any of our users want to weigh in here? Robert or Diane or Andrea? Do you see much of this?
I don't see a lot of defined benefit plans in my, in my movement in the industry. I just don't see it.
I would agree.
How about you, Robert? Okay. All right, so I don't think anything else. Thank you, guys. All right, we're going to get the Sachs and Max team to the table, and I suspect we may see just a little bit more of this in the not-for-profit sector. Okay, so joining us are Ashley Allen, Jennifer Weiss, and Caitlin Murphy. So I think Ashley, you're leading this, right?
Yep, thanks, Jeff. So since March 2025, the Private Company Council, or the PCC, has been prioritizing research on guidance on subjective acceleration clauses and determining the classification of debt as a current or non-current liability in a classified balance sheet. So I'll start with a brief overview of the current guidance. So a subjective acceleration clause, sometimes called a material adverse change clause, is a provision in a debt agreement in which a creditor can accelerate the scheduled maturities of the obligation under conditions that are not objectively determinable. Under current GAAP, when a debt arrangement includes a subjective acceleration clause, entities must assess the likelihood of the lender accelerating the due date. The outcome of that probability assessment will determine whether the debt is classified as a current or non-current liability, and also whether disclosure is needed. Some private company stakeholders have indicated that determining debt classification when a subjective acceleration clause exists can be complex, that diversity exists in applying that guidance, and that lenders often do not enforce these clauses. Next slide, please. GAAP also precludes non-current classification of short-term debt that is intended to be refinanced on a long-term basis after the balance sheet date, but before the financial statements are available to be issued, in scenarios in which the refinancing agreement includes a subjective acceleration clause. Also, if borrowings under a revolving credit agreement include both a subjective acceleration clause and a lockbox requirement, the borrowings are considered short-term obligations unless certain refinancing conditions are met based on an agreement other than the revolving credit agreement. And if a debt agreement includes a subjective acceleration clause and a springing lockbox arrangement, the effect of the subjective acceleration clause on debt classification depends on the outcome of the probability assessment. Next slide. On this slide, we've provided an example of a subjective acceleration clause in a debt agreement. Based on outreach that we've conducted with private company stakeholders, these clauses are common in private company debt agreements, but it is rare for lenders to successfully accelerate the due date of debt due to such clauses. Next slide. So the PCC last discussed subjective acceleration clauses at their September meeting and provided preliminary observations on potential private company accounting differences. At a high level, PCC members preliminary expressed interest in an alternative where instead of a probability-based assessment, debt classification would not be affected until a subjective acceleration clause has been triggered. The PCC had a robust discussion on what would constitute a trigger and requested that the staff perform additional research and outreach. And with that, we'd like to start the discussion with questions 1 and 2 on this slide. So question 1 asks about the prevalence in preparing classified balance sheets among non-healthcare not-for-profits. And question 2 asks how common subjective acceleration clauses are in debt arrangements of not-for-profits.
Okay, so let's start with the first question, which is how common outside of healthcare where it's required are classified balance sheets among different types of not-for-profits? Anyone want to weigh in, any of our practitioners in particular? Okay, Chris.
I find that it's not common at all, that not only, but most non-healthcare not-for-profits, in my experience, do not present a classified balance sheet.
Okay. Other practitioners, your observations? Go ahead, Brian.
I was actually going to say initially the exact opposite thing, but then once Chris spoke, I was like, I don't want to jump in. But yeah, I actually do see like fee-based not-for-profit organizations commonly presenting a classified balance sheet outside of healthcare. But the kind of non-fee based not-for-profit organizations, I don't know if that term makes sense, is commonly unclassified.
Do you, Carrie, do you see this much in higher education, for example, which is more of a hybrid type funding model?
We don't do that at all. Am I answering the right question? I was taking my notes copiously. I'm sorry, what was the question?
Oh, the question was, do you
we
see
don't classify
classified
at all.
balance sheets
No, we
among
don't at
higher
all.
ed institutions?
No, we don't classify at all.
Okay.
Actually, it is a lot of work for us when we consolidate to unclassify the healthcare to consolidate into the regular university financial statements, which are not classified.
Okay,
So
finally,
it's extra work for us.
Thanks, Carrie. Before we move off this question, anyone else want to make any observations about, I guess, more fee-based, not-for-profits sometimes doing? Any similar observations? No? All right.
Ellen.
Go ahead, Ellen, and then Dina.
I agree with what Brian said. I see it a lot in those that are more fee-based. So I would say it's quite common to have classified balance sheets.
Okay. Dina, go ahead.
I would agree with Ellen and Brian, and particularly in the independent school industry, and also in looking at, fundraising and receivables and debt obligations, and the needs to classify those.
Okay. All right, let's move on to the second question, which is about the prevalence of these types of clauses. I mean, who wants to, let me start with a couple of our bankers. You see it often. You have it often in the agreements you enter into.
Yeah, so material adverse change is in all of our agreements. That's standard language.
Okay, and you're lending to a wide range of nonprofits.
So yeah, across the spectrum, I don't do healthcare, but higher ed and the whole gamut of other types of not-for-profits, associations, foundations, cultural, K to 12. But that's a standard,
Same thing, Andrea?
I agree with Diane. It's standard, and but increasingly borrowers are asking for it to be negotiated out. So then it behooves the lender to figure out, well, in the absence of a subjective acceleration under a MAC clause, then what specifics can we define as a negative or affirmative covenant in the document? We can't possibly think of everything, which is kind of the purpose of the MAC in the first place. But if we're negotiating it out, what would we include then? Is there something else we would add to the conventional affirmative and negative covenants that could possibly happen that would, the loss of federal funding, for example, is that something that if there was a MAC, a bank would consider declaring a default? But in the absence of a MAC, is there something specific that says the loss of a significant funding source? So it's a bit of a back and forth in negotiation, but we definitely start there with it as a standard in the industry. And it's meant to be a catch-all for what didn't we think of that could happen in the future that would really jeopardize the borrower's ability to repay the loan.
Any other observations before? Hi, go ahead, Hillary.
Just a question. If it's standard language, how often do you actually accelerate the debt?
So from what I've seen, we wouldn't accelerate just on that. Typically, there'd be other aspects, maybe covenant defaults, fraud, a whole host of things. It wouldn't just be on that MAC clause typically that we would accelerate.
Same thing, Andrea?
I completely agree. Not just on a MAC. There has to be something else happening.
Okay, any other observations on that? I guess we've now covered questions 2, and I think that was 4. No problem. No problem at all. No problem. Cheryl, go ahead.
Thank you, Jeffrey. I just wanted to mention, I think the key to this is it being subjective. And so whoever is doing the lending has the ability to call the debt when they may want to. So that would flip it from long-term to short-term, which again gets back to the conversation about classified versus unclassified balance sheet, but it could actually flip an organization into a going concern opinion. And so what we want to make sure of as lenders for our program related investment entities, that we are very specific with what those acceleration clauses might be. And sometimes those would be, you're using the funds for a different purpose than what we had initially given them to you for, or perhaps you might lose your tax exempt status. So we try to make sure, like others had mentioned, there's some type of covenants or something that is actually defined, so that when their auditors come out and take a look at their loan agreements, they aren't going to say, oh, well, if that organization wants to, they could actually call the debt at any point in time.
So you've raised a good point here, which is, been thinking more along the lines of traditional bank type lending, but you're saying that you also include these often, typically, in programmatic lending that a grant-making foundation does to a operating charity.
That's correct.
Okay, great. All right, I guess we'll go. Sorry?
Robert.
Okay, Robert, go ahead.
Yeah, I guess this, to me, like dovetails on like the growth of private debt and the need to disclose around debt. I mean, we look at these as like contingent liquidity risk, right? And so there is sort of like the likelihood of these being exercised, and we realize that like in the vast majority of cases, there's waivers around these things, or there's a cost to accelerate that, it's unlikely that these often are sort of driving, collections immediately, but it is a risk, and there are most, favored nations clauses where there's cross default stuff. And so it's like really important that we get information around what triggers exist, who controls those in the debt disclosures.
Thanks, Robert. Pete?
Just to follow up on what Cheryl said, I think the biggest place I see this is from the auditor perspective is the going concern assessment, because if you have a covenant violation where this acceleration is an option, many times the lender will give a 1-year waiver, but that doesn't take you beyond a year from issuance date. So you're still stuck in this kind of going concern situation. So that's where I see the biggest problem, whether a classified balance sheet or not, that we have to end up spending a lot of time figuring out with the client.
Okay. Any other observations on prevalence and of these clauses and actual acceleration? Or move on to the other questions. Okay, if not, go ahead, Ashley.
Question 3 asks about the prevalence of revolving credit agreements that include subjective acceleration clauses, along with the requirement to maintain a lockbox where the cash collections, such as collections on student receivables, are automatically deposited into the lockbox and then applied to reduce the debt outstanding.
Thanks. Go ahead, Andrew.
So this question is really interesting to me because I'm curious why this research project is linking these two things. So we've talked, about subjective acceleration, and the lockbox arrangement is something that, to a lender, those two things are not really related. The lockbox arrangement is a way of improving a lender's claim on cash, but why is the project, can someone provide any background on that? Why is this project linking the lockbox agreement with subjective acceleration?
Okay, go ahead, Ashley.
Yeah, so there's under the existing guidance, if you have an agreement that contains both a lockbox and a subjective acceleration clause, unless you have another financing agreement in place, that debt would be classified as current.
Thank you.
And as for why those got linked originally, I don't know that I know.
Okay, but so now we understand. It's just because that's the way the policy, the convention is written that way. Yeah, because to a lender, at least to this lender, they're two separate things, and it makes a a loan situation more secure for the lender to have that degree of control over the collection of the cash in a lockbox. And it's not something I use often, but lenders sometimes use that structure requiring incoming cash to go into a lockbox to gain some level of control. I see that more in outside of the nonprofit world in asset-based lending, where the lender does want to collect the receivables directly, not necessarily in the nonprofit world, but I have seen lenders use that with things that you can't otherwise perfect on, like government receivables, because you can't get an acknowledgement from the government that they're going to pay you. So some lenders will use that. I personally have not done that often, but lockbox is a way of improving the bank's position with respect to cash collection, but I don't see it linked in the way I look at the business, linked to subjective acceleration, but thanks for explaining it.
Rich, did you want to say something?
Yeah, I mean, rightly or wrongly, I think it's because it's a revolving credit agreement. And if you think about it, you're paying it off each time. And there's a presumption you're reborrowing on it. Therefore, you don't have to have it as current. But if you have the subjective acceleration, you may not be able to reborrow on it.
Well, that's like with a line of credit where the line of credit is providing that working capital. So the collection of the receivable should pay off the debt, and the lockbox provides that discipline to use the incoming cash to pay down the line so that things really do revolve. In the real world, a lot of clients don't have that discipline and get themselves into some trouble because then they aren't using the incoming cash to pay down the debt. They're using it for something else, and then the debt doesn't get paid down.
And
so to your point,
this forces the payoff of the debt each time.
Yeah, so it does introduce a discipline.
I mean, I got my own feelings on this, but and the springing lockbox even more so. So
yeah, thank you.
Okay. Before I call on Brian and Diane, I know Jennifer wanted to say something here.
Yeah. Hi, Andrea. Thanks for the question. Nice to see you. So that guidance goes all the way back to 1995. It was an EITF abstract. And then the reason that they decided on what they did, it anchored back to a technical bulletin in 1979. So that guidance has been around for a while. If you want more information, we can research that for you.
Okay. So let's call on Brian and then Diane, and I know we have one more question to get to and move on to the next topic. Go ahead, Brian.
I was just going to say that I see this type of lending arrangement with a revolving credit agreement or an asset-based loan with a SAC and a springing lockbox in private companies, private company lending or borrowing a lot. I've never seen it in a not-for-profit organization.
Okay. Diane?
So, and I agree with Andrea, the only time I have seen it, and I have done it in my career, is due to a credit risk. You know, there's some kind of, you know, we're willing to do the credit, but we need the full control of those receivables. It's rare. Usually we want, you know, we leave it up to the client to make the payments when they receive the receivables. So it's an unusual structure for us, but if there's a credit risk, it does enhance the structure and, you know, and the overall, you know, security of the deal. But it's a rare occurrence.
Okay. Thanks, Diane. I know we have one more question to get to, right, Ashley?
So I mentioned briefly that this guidance also intersects with the intent and ability to refinance guidance. So the next question, it asks how common it is for not-for-profits to enter into financing agreements after the balance sheet date with the intent to refinance short-term debt on a long-term basis, and whether those financing agreements commonly include subjective acceleration clauses.
Okay. Anyone want to answer this? Go ahead, Diane. Thank you.
I mean, typically we would, as a condition of closing, would require the completed audited financials. If it's in the middle of a fiscal year, you know, we would look at management numbers, kind of what the history has been of management numbers tracking to audited financials and things of that nature to get comfortable. So, but we would still have the MAC clause in there. So if there was something that was drastically different, 6 months later, when we got the audit, we would have that protection.
Okay. Pete?
Yeah, I've seen this scenario come up. You kind of get into like the chicken and egg situation where kind of like with the line of credit renewal, they want the audit before they extend or do some new financing, but we need to see it to not have some sort of outcome in the audit report. So yes, I've seen a case where there was maybe debt covenant violation. So they go refinance something different where there's not similar covenants or something has changed, or they refinance with the current lender and change the covenants, but it's after the balance sheet date and you get into that timing battle.
Okay. Anyone else want to weigh in here before we move on to the next topic? Go ahead, Andrea.
So what I'm hearing in the question too is, yes, there can be a timing difference. Ideally, we have the audit before we make the final commitment and close the financing. But if there's a timing difference, I've never introduced the subjective acceleration concept because of the timing difference. So if we've negotiated a material adverse change clause, we've negotiated it. It's not because of the timing difference, which I think is part of what this question is asking. I've never introduced the MAC because of the timing difference. We take the risk that if we're closing without the audit, we're taking the risk that there's going to be a material difference between the financials they gave us, the internally prepared, and the final audit. I can't think of a case where it's not common. Maybe that's client selection, but the clients we're working with, they tend to have a really good handle on where their audit numbers are going to turn out. And so we haven't faced that, but to me, that is what was in the question. And I'll say, no, we don't introduce a MAC because of timing differences.
Okay. Team, have you gotten everything that you need? Is there any follow-up here? Okay, perfect. Thank you so much. All right, so we're moving on to topic 5, and this is going to be the Nellie Debler show.
That's right. Thank you. As opposed to the rest of the meeting where I was quiet.
No, it's going to update us on stuff that's already out there and stuff that will soon be out there.
Great. I know it's been a long day where we'll keep this kind of on the briefer side. We have a few updates for you on items on our agenda that have been recently completed by the board, maybe recently issued, maybe soon to be issued, but we want to give you an update on those. We really appreciate all of the feedback that the NAC provides to us throughout the process. Most of these are things we've talked to the NAC about a few times before. We're doing this to kind of circle back, let you know where it landed, see where everything are. I have 7 of these. If you have questions or observations as we go through this, I'd love for this to be interactive. So we're starting with our project on credit losses. On July 30th, we issued update 2025-05, measurement of credit losses for accounts receivable and contract assets. So this project was initiated by our private company counsel, and we heard concerns from multiple different types of stakeholders, but in particular from private company stakeholders about the costs of applying the CECL guidance, especially to shorter term assets. We gave the NAC an update on this at the March meeting, but that was kind of in the middle of our redeliberations process. So the guidance has been issued, it's available. This guidance introduces a practical expedient that's available to all entities and an accounting policy election that is available for entities other than public business entities, which does include not-for-profit entities. And those both relate to applying the CECL guidance to current accounts receivable and current contract assets arising from transactions accounted for under topic 606. So the practical expedient means that in kind of developing the reasonable and supportable forecast as part of the estimate of credit losses, an entity assumes that the current conditions as of the balance sheet date don't change for the remaining life of the asset. And then the practical expedient, which again is not available to public business entities, but is available to not-for-profits, is an entity is permitted to make this election to consider collection activity after the balance sheet date when estimating expected credit losses. So also for entities other than public business entities, both of these are available to be elected on what we call an evergreen basis. And specifically what we mean by that is that the first time you make this election after the effective date, you don't need to go through preferability in accordance with topic 250. So that's intended to make that a little bit more accessible. for entities that may not be ready to think about this now or don't find out about it until later or something else like that. So we just wanted to let you know this is issued and available. We're very excited about this guidance, and we really appreciate all the feedback we got from all of our stakeholders in order to get this across the finish line. Questions, concerns on this one?
Any questions for Nellie?
I've got a
Okay.
thumbs up, so
All
great.
right.
2 thumbs up, wow.
Okay.
Okay. The next project I'll talk about is our project on the accounting for software. So this final update was issued in September. Again, we talked to the NAC about this project in March as well. That was for this project right after the comment letter period ended and before we had kind of done the redeliberation side of it. So this project makes target improvements to the accounting for internal use software, which is subtopic 35040. And we call this, of course, internal use model, but it applies to a few different types of software, including like truly internal software, most types of software that are provided to a customer via a hosting arrangement, and implementation costs for cloud computing arrangements. That's the existing scoping of 35040. We didn't change that, but just when we say internal use software, we mean an amalgamation of things. So the guidance in 35040 currently has references to a prescriptive and sequential software development method, the kind of waterfall type software development. And the board decided to remove those references to help ensure that the guidance can be applied by all entities, regardless of what type of software development they're undertaking. This had been the source of some confusion in the past. The guidance also revises this starting threshold for capitalization and includes some additional guidance about how an entity would think about significant development uncertainty as part of the determination about when costs should begin to be capitalized. The guidance also removes the dedicated website development guidance, observing that websites and software are more similar than maybe they were at some times. That guidance was in subtopic 35050, and some pieces of that have been moved into subtopic 35040. And we think that the intent of that guidance would be the same for an entity going through the guidance in 35040, but we're just kind of combining them to acknowledge that they're less separate. And then lastly, as part of this project, the board decided not to require any incremental disclosures and rather decided to clarify that the guidance for PP&E in topic 360 would apply to internal use software regardless of how that's presented in the financial statement. So that could be an intangible, it could be with PP&E, but either way, the disclosure requirements in topic 360 would apply. And we hope this drives some consistency in what types of disclosures are provided about internal use software. As we were kind of working through this project, the board did provide some kind of indication of kind of what they expected to see as a result of these target improvements. We talked about this in the past, but the board landed on a targeted improvements approach after considering a number of different potential paths for this project. And generally for software that an entity is using as part of its business, like an app that customers use or software that an entity is using for its internal management purposes, the board expects that this guidance isn't going to necessarily result in a significant change in the level of capitalization. That may be different for entities whose business is developing software or who are thinking about things differently, but the board did include some of that kind of discussion in the document about what the expectation was here. And then I'll say this guidance is effective for calendar year end entities in 2028. Questions, concerns, observations?
Questions for Nellie?
About this one?
Okay, let's move on.
Okay, 2 down. No thumbs up for software. Very sorry. Also in September, the board issued a final update on our project related to derivative scope refinements. So like a lot of these projects that we're covering, actually, this project dates back to our 2021 agenda consultation, where we heard that the definition of a derivative may be applied in practice in a little bit more broad of a way than was initially intended by the board when that guidance was created over 20 years ago. And in particular, that may not result in decision useful information about some of these arrangements, accounting for them as derivatives may not. So this final guidance amended topic 815 to incorporate a scope exception for contracts with underlyings based on operations or activities that are specific to one of the parties to the contract. That's a pretty broad kind of principles-based type scope exception. So the guidance does list out a couple of what we say as exceptions to the exception, to just try and make sure that things that still need to stay derivatives. That includes variables based on a market rate, price or performance of a financial asset or financial liability, contracts involving an entity's own equity, and call or put options on debt. And the guidance goes through that specifically. And the final update does include some examples about different types of things that are meeting those scope exceptions or not. I think in our past discussions, we have identified that there are certain not-for-profit related type arrangements for which this guidance is expected to be helpful. I think we've talked about some of these, but in our notes, we had healthcare entities have certain kind of risk-based revenue contracts that may have run into issues with derivative accounting that may meet this scope exception. I'm sure there are other examples as well. This final guidance actually also has another issue. You can see here this slide is labeled issue 1. There's also an issue 2, which relates to revenue arrangements that have non-cash consideration in the form of a share-based payment. I'm not sure how common that is in not-for-profit space, but the update clarifies that topic 606 would apply to that arrangements until the uncertainty is resolved. And this guidance is effective for calendar year end entities in 2027. And we do have some entities that told us they were looking to early adopt this, so it is available for early adoption. But that's that. Questions, observations on this? Yeah.
Go ahead, Chris.
Sorry.
Oh, I was just going to observe, is his final ASU forthcoming? It forthcame, right?
Forthcame. That's right.
Yeah.
The slides were due before it was issued, so we were taking an abundance of caution.
I guess I just want to comment on the potential applicability to healthcare value-based care contracts. It's our initial thought, and I haven't discussed this with some other of the healthcare expert panel folks, but we believe that this likely is not going to help. Because the thing that we think is a derivative is actually not related to the entity's performance. It's related to, we think that they're providing a guarantee, so it's outside of their performance. So I think we're getting around derivative accounting through the insurance scope exception, which is maybe less of a steady ground to be on, but we don't think this will actually help that issue, but just for clarity.
I appreciate you clarifying that. That's very helpful. Anything else on this one? Any other questions? Yeah.
Chris, wasn't there something related to this with programmatic loans as well as we were going through the not-for-profit expert panel?
Yeah, for the programmatic loans, we characterize it in the guide as a scope conflict where something could be a derivative or it would be a conditional contribution. And I think in the guide, we said that you just have to pick one. I think this will solve that issue because it would be related, or it could be related to a not-for-profit's performance. Like, if someone gave a loan and if you do X, Y, Z, we'll forgive the loan. In some worlds, that would have been a derivative or it's a conditional contribution. And now that would be their performance. So.
Yeah, I think in the letter that the AICPA sent on the exposure draft asked for something more clearly about programmatic loans. But the question that came to us was, did the wording about it referring to occurrence or non-occurrence of an event, something like that, would that satisfy it? And I think we concluded it would.
Yeah, I know there had been some of that feedback in the exposure period. So that's very helpful. Anything else on this one? Okay. The next project is one that the board is hoping to finalize in the fourth quarter, our project on interim reporting. I think we've discussed this project with the NAC, but in any case, it's been a while, so I'm going to level set a little bit here. The intent of this project is to clarify what disclosures are required in an interim period. And I think it's also helpful to clarify what we're not doing, which is intending to change the overall level of disclosures provided in an interim reporting period. We're setting out to be consistent, essentially, to clarify what's required in an interim period. We think the guidance today is kind of old and cumbersome and not always clear. And this guidance also kind of reaffirms that an interim reporting period is an update to the annual reporting periods as well. So we've got two specific ways in which we're kind of making this clarification. The first is clarifying when the guidance on interim reporting is applicable. We've clarified that topic 270 applies to quote, interim financial statements and notes in accordance with GAAP. And that can be condensed statements or limited notes or both. And as an example, to kind of help understand what we mean by this, if an entity is doing just a balance sheet at an interim period and providing that to, say, a lender, that's not what this guidance means by interim financial statements and notes in accordance with GAAP. And so we're not in this kind of interim reporting landscape. That's not included in the changes we're made here. That's not kind of how we're thinking about this. We have a number of different ways we're kind of making this clear in the guidance in topic 270 to kind of explain what is meant by this. But it may not end up affecting many not-for-profit entities if they fall more into that camp of reporting that they do not really meeting that definition. Then the other series of improvements here is kind of improving what we're saying is the navigability of the required interim disclosures. It's not always clear what applies in an interim period and which disclosures are interim requirements or not. And over the years, we found that we have not been consistent in what wording we use when we're drafting disclosures about whether they need to be required in an interim period or not. So the board added a disclosure principle, which talks about what's required in an interim period. Again, thinking about interim as an update to annual. And then also created a list in topic 270 that identifies disclosures for which the board determined that the board at the time the disclosure was created were intended to be interim. So it's not revisiting what should be interim or not now by this board. It's what was intended by the board at the time the disclosure was created. So again, we're trying to clarify that rather than revisit in its kind of its entirety. And the document ends up quite long, this final update that's forthcoming, because we're making amendments to the individual disclosure requirements also to kind of help try and make that clear throughout the codification. So this guidance, to the extent it's applicable, is effective for calendar year end entities other than public business entities in 2029. Questions, concerns on this one? Great.
Don't see any.
Moving along through our exciting maintenance of the codification section of today's agenda. This is another project we're hoping to finalize in the coming months. We talked about this one with the NAC in March as well, because it includes about 10 issues that relate to not-for-profit entities out of about 33 total. But let me back up a little bit just to level set again. The board has a standing project on its agenda that we call Codification Improvements. And the goal is just to maintain, improve the codification. We accumulate questions for this project over time and then kind of deal with them, address them in a batch. And the last time we did a batch before this one was 2019. So we accumulated a number of issues that go into this. Generally, when the board is making these clarifications, we don't expect significant changes in practice. We don't expect significant costs to be incurred by preparers. But we know that when we change the words, there's always an outside possibility that there is some kind of change in practice or somebody looks at something differently. So this project goes through the board's full due process. There's deliberations. There was an exposure draft. We did the redeliberations process earlier this year. And even though changes are not expected to come out of these clarifications, the board does provide transition guidance for these items, like as a belt and suspenders, just in case. As I mentioned, there are 33 issues in the final update. If you are counting, there were 34 in the exposure draft, and we decided that one of them needed further research. They relate to a bunch of different topics. As I mentioned, a number of them do seem like they may affect not-for-profit entities, but it's hard to kind of summarize or generalize. I want to call out one of them that we've discussed that I think is on the next slide. There's a paragraph in subtopic 958.310 that states that receivables from exchange transactions that are due within 1 year can be measured at net realizable value. And we heard feedback that this paragraph was unclear and could be viewed as inconsistent with the CECL guidance and how that would be applicable. So the board decided to address this as part of this project. And in the redeliberations, the board decided to just remove the paragraph for the avoidance of doubt. So that's going to be addressed. And then I'll just briefly mention, as part of the redeliberations, the board did decide that the transition here can be on an issue-by-issue basis. So if there's some of these issues that may be impactful or that may be helpful or clarified, an entity could adopt those and then kind of separate out other ones at different times. And these amendments are effective for calendar year and entities in 27. Questions, comments on those? Yeah.
The one issue that was taken off out of the final standard, is that going into the hopper to consider going forward then?
Yeah, it stays in our process essentially. It was, we proposed a wording edit and people responded essentially like, those words don't work, but we still think you should fix it. So we're going to keep working, come up with something else, come up with another way to change it, but it didn't feel like it was worth rushing now, so.
Yeah, thanks for your input on that particular issue,
Yeah.
Chris.
Just a quick administrative question. Did the Codification Improvements ASUs, you said they are subject to the same due process. Do they include post-implementation look or review?
To the extent that we look at all of our standards after they're implemented, yes. They're not kind of part of that formal trustee-based process because they're pretty nuanced, but we do think about all this kind of stuff. This is an ongoing process to accumulate these issues and sort of decide what to do with them. Sometimes we'll have the question of an issue that comes in through the feedback or codification improvements type process, ends up being bigger than we think it is and needs more time and energy, gets broken out separately. Other times they get batched like this, but in any case, kind of regardless of how it's addressed, it's going through that due process, being exposed, transition requirements for the case of this one, just in case, so.
I was just curious, but thank you.
Okay, I've lost track of how many we've made it through, but we've made it through some. So the next one is our environmental credit programs project. This was redeliberated by the board in August, and the team's in the process of drafting the final update for this one. We talked to the NAC about this project also at the March meeting to kind of give an update there. I'll level set again. This project is addressing the accounting for environmental credits and environmental credit obligations associated with that. And again, I'm going to explain what this project doesn't do, which is address the accounting for carbon emissions or sustainability reporting or anything like that. The FASB's mission is really limited to financial reporting, and that's what this project is doing. There are transactions in the marketplace where people buy these credits or in some cases are granted. And that's the type of transaction, financial reporting transaction, that this project is addressing. So this was a proposed update in 2024, and I mentioned it was redeliberated in August. The guidance has definitions for the types of credits that are in the scope of this project. It includes renewable energy credits, RECs, renewable identification numbers or RINs, carbon offsets, kind of the standard types of things that you might think about. And at a high level, this guidance requires an entity to account for those credits based on the intent. So we have 3 types of credits: compliance, non-compliance, and voluntary. An entity first assesses whether the credit is going to be used to settle an obligation or sold kind of either collectively. And if it's, in that case, if it's probable, it falls into that compliance, non-compliance bucket. And if it's not probable of being used to settle an obligation or sold, then it falls into that voluntary bucket. Those are expensed as incurred, and that would include items that an entity would be like buying and intending to retire as part of a net zero type commitment, something like that is what we think is going to fall into that voluntary bucket. The compliance and non-compliance bucket are separated based on whether they are individually probable of being used to settle an obligation. So in that case, they're essentially not tested for impairment. If you know that that's going to be used to settle a regulatory obligation, that's what gets you into that compliance bucket. Sounds like Jack wants to say something.
Can we back up a slide?
Sure.
There we go. Just wanted to point out the scope exception was included at the request of the NAC. So.
Okay. I think that's everything I was going to say on the asset side. For the liability side, an entity only recognizes a liability here when it has an enforceable obligation that arises from a regulatory compliance program. So again, if an entity is in a voluntary initiative like a net zero commitment or something else like that, that's not what we mean by these obligations. If an entity does have that regulatory compliance obligation, that's measured assuming the end of the current reporting period is the end of the measurement period, and that measurement is split into 2 pieces, the funded and unfunded portion that you can see here. The funded portion is connected to the compliance credits that we just identified on the previous slide, essentially the portion of the liability for which you already have the credits that you're going to use to settle that. And in that case, we call that linked measurement. The liability and the credits that you already have are linked. The credits aren't impaired, so they're just kind of connected in that way. This unfunded portion is the portion of the liability for which an entity does not have credits. And that's measured at the fair value of the credits that would be needed to settle that obligation. Slight nuance there, not the fair value of the obligation, but the fair value of the credits that would be needed to settle the obligation. I'll briefly mention the proposed update had fairly extensive disclosure requirements, and this was a source of a lot of comment letter feedback from our stakeholders. The board did make a few changes to those disclosures in redeliberations. The board decided that the disclosures would be required for annual periods. The quantitative disclosures required include the amounts of credits recognized as assets and expenses and the change in the entity's intended use of credits. But there were a couple of disclosures that the board decided not to finalize here, some significant holdings disclosures and certain income statement disclosures. We hope to issue this guidance in the coming months, and it's effective for calendar year-end entities other than public business entities in 2029. Questions? Observations?
Any questions for Nellie here? Okay, one more.
Last but not least, we have made it. There was a thumbs up, thank you. This is our project on debt exchanges, which is an EITF project. I don't think we've talked about this one with the NAC. Let me explain a bit about how this got to the EITFs and the board's agenda. We got this request into the EITF in the summer of 2024, and the EITF made its recommendation in October. It was issued for exposure this spring, and then the board completed their redeliberations a couple of weeks ago, last month, who knows, recently. Under current GAAP, when an entity modifies an existing debt instrument or exchanges debt instruments, then he has to go through the guidance on whether that's a modification of the existing debt obligation and the issuance of a new one and extinguishment, the 10% cash flow test and so on. And stakeholders have noted that that may not reflect the economics of what's happening in those exchanges, and that 10% cash flow test about whether it's a modification or extinguishment is challenging to perform, and there can be some diversity in practice about how that gets applied to these transactions. So for exchanges of debt instruments that meet certain requirements, this guidance will specify that those should be accounted for by the debtor as the issuance of a new debt obligation and the extinguishment of the old debt obligation. And the board and the EITF established two criteria for this, which is the existing obligations repaid in accordance with its contractual terms or repurchased at market terms. And then the new debt obligation was issued at market terms. So if those requirements are met, you go right to extinguishment accounting, and an entity doesn't have to perform that quantitative analysis of the change in cash flows. If you don't meet these requirements, you go back through that other guidance to assess whether you're in the modification or extinguishment place. And we acknowledge that this is kind of describing maybe a subset of debt-related modification type transactions. This applies to debtors that interact transactions that are within the scope of this guidance in 47050 and involve the contemporaneous exchange of cash between the same debtor and creditor in connection with the issuance of the new debt and the satisfaction of the existing debt. So we hope that this helps simplify some of this guidance, provide a little bit of clarity here, but we recognize it doesn't change all debt modification type transactions. It's kind of getting at a subset. And this guidance is effective for calendar year end entities in 2027. That we're currently drafting the final update for this and expect that to be coming in the coming months. Questions or observations on that one?
Any final questions for Nellie?
A thumbs up. Thank you.
Yay. Okay. Awesome. Well, thank you, Nellie. That was whirlwindish.
Yeah.
That's great. Okay. I only have really one more important item of business here, which is to thank our 7 NAC members whose terms end at the end of this year. I'm going to go in alphabetical order, and I'll ask each of you guys to stand, and you guys online, 2 of you can stand as well if you like. Okay. So in alphabetical order, they are Brian Connor. Thanks, Brian. Alex Galliano, if you want to stand. Okay. Andrea Cantor. Brian McAllister, again, if you want to stand. All right. Thanks, Brian. J.R. Miller. Dina Paradis, and Ksenia Popke. I wanted to really thank you. I want all of us, I know, want to really thank you both individually and collectively for all of the really good advice and work and feedback and input and all that other stuff that you guys have given us over the last almost 4 years. I want to wish you all well, and we will have a token of our appreciation coming to you sometime later this calendar year to your homes, your business, whatever address we have. Anyway, I really wanted to thank you. All right. And speaking of thanks, I wanted to thank members and participating observers. I wanted to thank the board, thank the staff, and thank the audience for being with us this day. Our next meeting is on Thursday, March 19th, and I wanted to wish you all a wonderful holiday season and stay safe and well, everyone. This meeting's adjourned.